Welcome back to The Explainer. Today, we're peeling back the layers on a seriously bizarre financial mystery. Something very, very strange just happened to Origin, a company trading under the ticker BTOG. Now, at first glance, this might look like a story you've heard 100 times before, but I promise you the headlines are hiding a massive, high-stakes gamble. So, BTOG recently took a nearly 11% nosedive in a single trading session, landing at $3.32. And if you just glance at the chart, the story seems pretty obvious, right? It looks like just another tiny stock, another huge sell-off, and another company that investors should probably run away from. But that's exactly where things stop adding up. Because Origin isn't just selling off. They're actually attempting to build something completely different from the business investors knew before. They are attempting a massive, ground-up pivot into AI infrastructure. Which brings us to the central question for this explainer. Is this sudden crash the noisy, messy birth of a massive AI turnaround? Or is the market trying to warn us that the glamorous story is simply moving way faster than the actual business? Well, to figure that out, we need to gather the evidence. Chapter 1, A History of Collapse. Because before we get distracted by AI, NVIDIA, or anything futuristic, we have to look backwards. You see, investors often make this critical mistake with turnaround stocks. They fall in love with the future before they even understand the past. And here, the sheer scale of the deterioration is honestly staggering. Origin's previous business was heavily tied to crypto mining. In fiscal 2023, they brought in roughly $6.26 million. In 2024, that dropped to $2.89 million. Then fiscal 2025 hits, and revenue basically flatlines at just $39,495. That is an astonishing 98.6% decline from 2024. And on top of that, they still took a $4.37 million net loss. So the key takeaway here, this isn't some established company smoothly expanding its operations into AI. This is a desperate attempt to replace a totally collapsed business model. Chapter 2, The $11 million Bet. All right, here is where the narrative completely flips and the story gets incredibly interesting. In June 2026, Origin announced they were acquiring approximately $11 million worth of NVIDIA Blackwell B300 AI infrastructure. We are talking about 16 highly coveted AI servers expected to be delivered in the third quarter of 2026. They aren't just slapping the letters A and I onto a press release to get attention. They are claiming the acquisition of serious, hard assets sitting right smack in the middle of the accelerated computing boom. And check out the company's projections for that hardware. Origin expects these servers to generate around $360,000 a month before operating expenses once they're fully up and running. If you annualize that, it's roughly $4.32 million. To put that into perspective, that is potentially more than 100 times their entire reported revenue for fiscal 2025. If they pull this off, BTOG looks like a completely different beast. But let's pump the brakes for a second, because owning GPUs is not the same thing as owning a business. That infrastructure is only valuable if customers actually pay to use it. Now, Origin says their initial deployment is tied to contracted customer demand and hosting arrangements, which, sure, is a great sign. But as smart investors, we have to separate this into 3 steps: announced demand, contracted demand, and recognized revenue. A contract doesn't magically guarantee attractive economics, and projected revenue is a very long way from audited, recognized revenue on an income statement. Chapter 3, The Balance Sheet Reality. Now we've got to pivot our investigation to what's hiding beneath those flashy NVIDIA press releases. On one side, we have this amazing futuristic expectation: NVIDIA Blackwell servers and $360,000 a month in potential revenue. But on the other side, a pretty grim reality. At the end of June 2025, Origin reported having only $55,639 in cash. Their operating cash flow for 2025 was negative $2.29 million, and their accumulated deficit, by June it was over $88 million, and by December 2025 it had ballooned to a staggering $106.65 million. Which leads us to a very dangerous financial question. How exactly does a company with a massive deficit, burning millions of dollars, and holding just $55,000 in cash, fund an $11 million aggressive infrastructure expansion? Seriously, where is that money coming from? Chapter 4, Dilution and Reverse Splits. This is the chapter a lot of retail investors just skip over, and honestly, it's absolutely crucial. When a company lacks cash, growth has to be funded somehow, and it's usually funded by you, the shareholder. Origin entered into an equity purchase facility that allows an investor to buy up to $400 million of newly issued Class A shares. Now, to be fair, that doesn't mean $400 million in dilution happens all at once automatically, but it means the possibility is definitely there. There's a massive difference between a company raising a little bit of capital to spark growth and a company repeatedly issuing new shares just to keep the lights on, slowly diluting your ownership piece by piece. And that dilution leads directly to the dreaded reverse stock split. Origin actually just completed a 1-for-5 reverse split. So 5 of your shares simply became 1. As we know, this is purely a mechanical adjustment just to push the share price up artificially. It's like taking a pizza and cutting it into fewer, bigger slices. You don't magically have more pizza. It gives the stock a higher nominal share price overnight, but a stronger underlying business, that takes years to build. So the reverse split isn't proof of success at all. It's just evidence of a survival tactic. Chapter 5. Bull Case versus Bear Case. Let's impartially lay out the two completely opposite futures battling over this stock. In the bull case, the AI computing demand boom is 100% real. Origin actually deploys those 16 Blackwell servers, utilization is strong, customers pay up, margins improve, and they manage to finance the infrastructure without excessive dilution. If all that happens, they completely transform their revenue profile. It's a massive win. But in the bear case, deployment gets delayed, customer utilization disappoints, operating costs spike, and the company has to issue so many new shares just to survive that even if the business grows, your percentage of ownership shrinks down to nothing. You can literally lose money even if the company survives. And that's exactly why we have to remember, revenue is not profit. Beginner investors just buy the flashy revenue headline, but experienced investors, they look at the expenses that are going to eat away at that projected $360,000 a month. We're talking electricity, hosting, data center costs, maintenance, taxes, depreciation, and financing. The real question is, how much free cash flow actually survives after all of those bills are paid? Chapter 6. The Final Verdict. It's time to figure out exactly who should be paying attention to this highly speculative setup. Let's filter our audience right now. If you're an income or conservative investor looking for reliable dividends, just stop right here. The risk profile is way too extreme for you. The accumulated deficit and the cash burn take this completely off the table. However, if you're a growth or speculative investor, the upside of pivoting into NVIDIA Blackwell infrastructure is genuinely fascinating. But it absolutely demands strict hard evidence before you take any action. So here's your highly actionable takeaway. These are the 5 exact metrics you must watch in their next earnings report. Number 1, AI revenue. Is it actually showing up on audited statements? 2, utilization. Are those GPUs getting meaningful, consistent usage? 3, cash flow. Is this new business producing actual cash? 4, margins. What's left over after the heavy infrastructure costs? And 5, share count. Is the company growing its value faster than dilution is expanding the ownership base? Which brings us to our final impartial verdict for Origin: watch, but with extreme risk. Based on the evidence we have today, it's definitely not a clear buy. But the massive drop alone doesn't necessarily justify a sell either. The market isn't giving us a proven AI business quite yet. It's giving us a high-risk attempt to create one out of the shell of a collapsed crypto miner. We simply have to wait for the financial statements to catch up with this glamorous AI story. Until then, you just watch the numbers. But as we close out this explainer, I want you to think about the complete opposite end of the spectrum. Origin is struggling to create an AI business from scratch, but the next company on our list has a totally different problem. They already have a business. They already have customers. The revenue actually exists and it's flowing in right now. So why did Wall Street just throw it away? Are they seeing some hidden, fatal flaw in the financials, or did they just toss out a perfectly good company by mistake? That is a totally different financial mystery, and we're going to solve it in the next explainer. I'll see you there.